Good evening, ladies and gentlemen. Well, only gentlemen tonight. I understand that it's a warm summer evening everywhere, and people are out. And I do not didn't. I hope for a larger attendance because we have quite a few people who have signed up for this ACS coaching sessions. But I do understand that everyone has to deal with families like I do, and enjoy their summer months while they last. So this will be a free ACS coaching session, so you guys actually will have no credits will be taken off from the from your paid sessions. So keep that in mind. This will be counted as a free complimentary session. Okay. This is Clueless 8 Trading. Frank, this is an advanced coaching session and free webinar for anyone to attend. Full disclosure, this is purely for financial education and not for any solicitation or advice. And we shall begin the session right now. This will be recorded and uploaded to the YouTube channel for all members and free trial subscribers to benefit from and review before the market session starts tomorrow. All right, so let's start off with a couple of important observations that I always start off with. Number one, this market is what we call in our business, and as you all have seen, is what we call a very, very powerful stealth rally. It's a market that no one expected to go higher, and that includes me. Even though I projected movements higher, the fact that the market right now is about to kiss 2200 and the Dow Jones is on a distance, stone's throw distance from hitting 19,000. To be honest with you, at the time of Brexit, when we hit those very ugly lows on this 976 point drop in the market down to 1990 on the S&P 500 and 1980 or so on the E-minis, the ES. Again, it doesn't matter how bullish somebody is. I knew the world wasn't going to end, but I'll be the first one to admit that despite my projections, which I did show that we had a good possibility of hitting highs, I did not expect the market to be hitting 2200 that fast. It's just the way the markets go. So let's start off with a couple of important observations in a very simple chart here on the S&P 500. Let's start off with a reference point, which would be the Brexit crash. Now, before I go further, I know all of you, David, Tim, JB, we have Anoop here joining us, and I think some other people trying to sign in, is do try to, as much as possible, in between your busy workday lives, try to keep up with my postings. I don't mean that you have to sit there like a PhD scientist and dissect every single chart that I put out there. Well, do dissect the ones that you're trading in, because my charts are generally quite accurate within the time frame that that I present and within the parameters of where they're going to go. But the other articles and different things that I put through will help you manage your trades better. A couple of articles that I put out there this weekend which caught my eye, and there was another one that I actually wanted to put in, but I will do it tonight, about the Chinese market, the Shanghai A-share market about to have a technical breakout. That I noticed last week. And if you notice the performance of Chinese stocks on this side of the coin, Alibaba, NetEase, Baidu, and a whole bunch of others, but those are the main ones, you will notice that they are on a major technical breakout. And I managed to catch on to Alibaba. NetEase is something that's on my screen. I did not get a chance to really go ahead and issue a signal on that because we were so busy with some other stuff. But the fact that the Shanghai market is about to have a technical breakout in a major way has to say something about what's going on in the global front. A lot of American traders out here sitting in the US always look at the world in the eyes of what we think the world should be doing. That is our major failing. I always used to tell my clients on Wall Street that the world where we live and what we do as human beings, we like to look at our lives as in the same fishbowl, as if what we think is exactly what's going to happen. Sometimes it's very, very important for us to take us out of the fishbowl and look in instead of always look out. If we're always in the same zone, in this particular case, the United States financial markets, and always like to project out, then we are very wrong a lot of the times. So sometimes you have to look in from the outside in and see where, what's going on here. And the fact that the global markets are really picking up right now, despite all the massive negative media attention on every single time that the markets are moving higher, says a lot about the overall fear, uncertainty, and the bearish feelings that are out there, bearish sentiment that are out there, which in itself creates the fuel for markets to go higher. I think we all know that, but I'm making that point in a very serious way. Even myself, who has been overall on a tactical basis, overall bullish, and have done extremely well, thank God, with all my work, all the charts and everything, and my overall feelings about the market, I'm not acting the way I did back a couple of years ago. Okay? In other words, I am still cautious, and my trades are tactically very good, but I am not trading as aggressively. And I'll be the first one to admit, I'm a straightforward guy. I'm not trading as aggressively as I should. And imagine what the rest of the world is doing. They're either hiding in a cubby hole, or in this case, a grizzly bear hole. Okay, and every time they're trying to short the market, right, left, and center in any big way, they're dying. And this will continue to the point, okay, from a technical standpoint, where things get a little bit nutty, and the market, possibly, I'm saying, zooms through 2200, and then all of a sudden everyone's starting to get a little bit happy and lazy. Okay, happy and lazy equals complacency, and bang, the market hits hard. Now that could happen as early as this week. It could happen as early part of next week. Okay, I'm just letting you all know. So we'll go through the technicals of that, but the fact is that there are big things going in the market, and a significant amount of players, and institutional players included, are now getting really nervous. They're not getting nervous because we're about to crash. They're getting nervous is because they're not making money. Now, if you're in the world of money management, which I was for many, many years, and you have large clients who are demanding to see returns on their money, and they're making more on their index funds, in other words, like Vanguard or somebody like that, okay, where it's passive investing. They put money in there, and they track the S&P 500, the Russell 2000, the QQQs, the NDX, right? So it's like they're just mimicking what the market's doing, and their returns are up 6, 7, 8% for the year, and they're active money managers that they're paying every single year are sitting there giving them 1%, 2%, or maybe negative returns because they haven't invested their cash fully. You can imagine how scary a situation that is. Because at one point, they'll just take their billions out of those hedge funds, out of those mutual fund managers, and put them with Vanguard and funds like that, which simply mimic or index, in index funds. In other words, mimic what the market is doing. Now, what I just said, did that make sense to some of you? Because if it didn't, it's a very important point in the way we are trading this market. So what I just said, did it make sense to you guys?
Yes.
Okay, David said yes. Anup?
Yes, yes.
Okay, good. JB?
Yes, sir.
Okay, good. So I try to keep it simple, So that's really what's going on here. And the fact that the constant barrage of the negative narrative and the political narrative in our current state of affairs, both in politics and finance, talking about the big, massive, ugly black swan attack, which basically means this type of event, from nowhere, and the fact that we're doomed, and the U.S. just can't do anything and that we are finished and we're losing to everyone in the world, in my opinion, is garbage. Okay? We have a lot of problems, and there's a lot of problems that we need to fix. There's no question about it. No question about it. I'm a fiscal conservative. I'm a Republican. I've always said that. And I believe there's a lot of things that can be fixed. This regulatory environment that we live in, putting excessive regulation on our great companies, on our banks, is absolutely wrong. The fact that we don't have tax reform on the form of corporate tax reform, mind you. Corporate tax reform. We don't need to have, honestly speaking, we don't need to have some massive tax reform on the personal side. Our tax code overall is fine. You don't need to tax billionaires more. Believe me, they pay enough taxes. You don't need to tax, you need to give freebies out to the, to the lower income producing masses. They get enough benefits, believe me. But, so personal tax reform is really not my issue here. We don't need to cut, the uber wealthy's 0.001% don't need, they're not screaming and shouting saying, cut my taxes. All right? They get enough tax breaks and stuff, and believe me, there's enough loopholes out there to pay as little taxes as possible. Anybody with half a brain will tell you that. But corporate tax reform is a different story. We need to bring back significant amounts, maybe trillions of dollars that are sitting in outside offshore accounts, because once they get into the U.S., they have to pay 30% plus on their taxes. That's horrific. Why? These are earnings that companies earned abroad, U.S. companies, one of the greatest companies in the world. So why should they pay 30% in taxes? Because they're repatriating the money back home. That's wrong. So that type of tax reform is critical, no question about it. So without getting too political and stuff and all that, the bottom line is that despite all the problems and stuff, U.S. companies in general, overall, have survived this entire environment from 2009 very, very, very well. Okay, and so that's it. That's as far as I can go. So saying all that, the constant barrage what we get from the media that everything is just rotten and we're just going to fall into a big black dark hole is garbage, number one, in my opinion. This is my opinion, okay? And that U.S. companies are really terribly suffering, garbage. We are still the world leaders in so many fronts, it's not even funny, okay? Now, once you get some meaningful tax reform on the corporate side and stuff, I am positive that there will be significant amounts of high-skilled jobs, mind you, high-skilled jobs that are going to be created in the U.S. So if some bozo wants to sit there, not study, okay, smoke pot, drink moonshine, all right, and then expect to make $30 an hour, well, he ain't going to get it because that's not capitalism. That's bozo welfareism, all right? So the bottom line is if people think that they all of a sudden make nice loads of money because they didn't work hard enough to change their skill sets and adapt to the new reality of what this world is all about, the 21st century world, and competing with global superpowers whose kids are studying 24/7 and beating the pants out of our over average so-called American student, okay, in math, in science, especially in those fields, which technology, right? Well, there's no handouts. No jobs will be created. You got to adapt to the new world. Your brain is your ATM machine. So if you want to fry your brain and drink beer and just lie around like a lazy bum, well, you'll never have any job that's going to be meaningful to you. Okay? So just remember that. So the reality is that in order skill jobs, not necessarily high skill. We all can't be Elon Musk, okay? We all can't be Sundar Pichai. We all can't be Sergey Brin. We all can't be, Peter Thiel and all these great people who have transformed the world and Bill Gates. But we can certainly, and this is really important, and but we can certainly try to use our brains as much as possible, learn some new trades, learn some new skills, and move forward. That's how you compete in the global arena, not by screaming and shouting and saying, oh boy, you know, I want my $50 job back because I was working in the steel mill. It ain't going to happen, because those jobs are not just gone overseas. Those jobs have been taken over by robots. The robots who are making that, rolling that steel, that high grade steel, is not going to get fired. It'll just keep on working 24/7. That's just the way the world is. I think we all know that, even though we don't want to accept it. So the reality is that, in my opinion, there is danger in the global economy. There's no question about it. There's a lot of kinks on what's going on. However, it's not the end of the world. Like I said a long time ago, by the time it's the Mayans land, you know, like the end of the Mayan calendar, we were supposed to end somewhere like 3-4 years ago. We're not going to even know it. It's going to be over. The end of the world is going to be one big asteroid hitting Earth. Believe me, that's exactly what's going to happen. If you guys really study astronomy, you'd know that, okay? One big asteroid hitting the world. And that's it. It's over. One flash, gone. No trades put in, no stops triggered, bond, finished. All right? So all kidding aside, that's just the way it is. So the doom and gloom scenario is a big industry. It's a big industry, okay? It's a multi-billion dollar industry to scare the living daylights out of people. And that's what's caused them a significant amount of cash, even in large circles of institutional money, to sit on the sidelines, okay? And what happened here, and that's what I'm getting into, is what's propelling the market from doing what it's doing right now. So keep that in mind in the context of whatever you're trading. When you think that everything can just plop down and just go down 50%, it just won't happen like that. Now, if something happens completely out of the ordinary, okay, that's a different story. We live with that possibility every day, that we won't wake up tomorrow morning, all right? So that's the way it is. So saying all that, what happened here in Brexit was key. When we saw this type of, let me clean this out a little bit. When we saw this massive crash here, okay, and believe me, we were a lot lower back in January and February that people tend to forget. I asked one of my neighbors, big shot guy, okay, I said, hey, listen, hey, when you think that, I meet him all the time, I'm walking my dogs on the waterfront. So he goes, hey, how's it going? I'm like, moving along, like they say, one day at a time, and we're kicking butt. Clueless say trading is the trading version of ballers, okay? Just kidding. So the bottom line is that I said, you know what? Tell me something. When that thing happened with Brexit, that was really ugly, right? The guy goes, yeah, man, that was nuts. And I said, what do you think the low on the market was? She goes, during Brexit. I said, oh, yeah, sure it was. That's what happens. People don't know. And this guy he's got 2 yachts right on the docks around here, overlooking his house. He's very smart. He's an IT guy, born and brought up here. And he's telling me that during Brexit was the low in the market. That's called cognitive negative bias. Because he had no idea. We were a lot lower, retesting this 1800 level, which we had retested back here, by the way, which I'll show, back in 2015. During the oil collapse and during the time that the junk bond market basically went into a free fall. So this was the low. The 1800 was low. The 1990-2000 level that we tested was not even close to it. But that's what people think was the low in the market. So what I'm getting at is that people have absolute, because their brains are so clouded, and that includes all of you too. Okay, believe me, that includes all of you too. The brains are so clouded with fear about how bad the markets can be that we tend to lose sight. Traders tend to lose sight of what is in front of them. I've said a few times, and I mean that, when you're looking at a stock making a powerful breakout, don't look where it's coming from. Focus on where it's going. Once you start to change your mentality, your behavioral mindset in that way, you will stick with the trade. And if 1 point move won't let you get out of it. And you all know very well what I'm talking about, because it's happened repeatedly to each of you. It's happened to me in a certain way, but at least, you know, I mean, I'm kind of programmed myself to to stay away from that type of thinking. Like they say, it's not where you came from, it's where you're going. That is life. That is America. And that is life, okay? It is not where you came from, it's where you're going. That applies to stocks. That applies to stocks. So if a stock like Yelp is having a massive breakout all the way from the lower levels, we're going to study that too, because and the stock basically was at 14 when nobody was looking at it. I wasn't either, and it had a monster macro breakout over the 29.30 level, and now is barely at 38, and all of a sudden everyone's just like, you know. And I'm tactically showing where it can go. I'm not saying it's going back to $200, $100. I'm saying tactically that it's going to, and I've said this, and I've showed this repeatedly. Forget what I say. $44, $46. I've put some beautiful charts out there. Yet people make silly comments because they're not looking at the technical picture. They are stuck on where the stock was. What the stock was has no bearing. So saying all that, so this was a powerful formation. Dragon bullish, big time powerful, and it had a neckline breakout right here, and you apply this the same way, like I repeatedly have shown with stocks too, and that was around 1950. Okay, and once it broke that, in between consolidation days, these are those consolidation days when the room is silent, no one wants to talk, everyone's scared because some of you are not focusing on like the resets and stuff, which I know takes training. I understand that. I've gone through it. So in between these minor resets and stuff, the primary trend remained higher. And basically till about 2100, the markets did nothing. So in other words, from November of 2015, okay, from November of 2015 till this monster breakout, which I called, I'll take full credit for it. Okay, the ascending triangle, you know, all kinds of different patterns that manifested itself. This was a monster inverse head and shoulder. Here's your Brexit head. Here's your left shoulder. Here's your right shoulder. Here is your neckline. And here's the big fat breakout into a consolidation channel, which I must have shown at least 30 times. And the market stayed within the consolidation band. There was a fear that we would break down below that because that's what it looked like. But lo and behold, it touched the bottom of the band and decided to say, I'm moving higher, and broke out into a newer trading band right now. Very tight, very tight. Not to mention that we can fall back into the trading band. Sure we can. But we're going to go over the technicals that you guys have to monitor from your side. Not to mention that I always constantly keep on reminding, which will, which will allow us to keep a focus on what's going on. So saying all that, if you really think about it, and I'm going to keep this clean, we had a, draw this again as much as I can by pulling my, there you go. All right. So let's keep this simple here. From November of 2015, which seems like an eternity ago, the January crash and the subsequent massive breakout that everyone has forgotten, believe me, they have, to the big move higher. And remember, this one, 90% of traders missed out too. Not in our group. We're trading it in segments. We were doing fine. I didn't buy here and say, oh, I know everything. It's going to go all the way and test that. Because those are lies. Okay? But a $10,000 investment here would be north of $140,000 here. Period. On the pure indices, on SPX. But we, like I always say in trading, you eat what you kill, and you basically trade the middle. So even if you got 40% of this, of the meat in the middle, let's say this much, you made a ton. You made a ton. But for that, you need to understand technicals, you need to understand the underlying thing, of course, and you need to understand my comments that I put out there regarding the overall background of what's going on. Saying all that, from November 2015 till July of 2000 and first week of July of 2016. Can somebody fill in the blank what I'm going to say next? Because I want you guys to use your brain too and not become an unemployed steelworker in Pittsburgh. So please fill in, somebody step up and fill in what I'm going to say next. I'll repeat again in simple English. From November of 2015 till July of 2016. How many months is that? December, January, February, March, April, May, June, July. Whoa, 8 months, the number 8. So on this infamous month of number 8, on the 8th month, what am I going to say next? Please, we don't have time to waste. So somebody step up and tell me what I'm going to say next.
Break out of the channel.
You're close. Say it in simple English, like you're explaining it to your 8-year-old nephew. How about that? No technical terms needed. JB?
Gonna go up.
I'm sorry? I'll repeat. I'll repeat again. No, that's not good enough. You're smarter than that, JB. From November of 2015 till July of 2016. The market did what? I mean, come on, guys. You must be, Nia, you step up and tell me. No one? Tim? Tim? Because that's how you got to train your brain to think. It's very simple. Tim, can you hear us?
Sorry, I was busy.
No, I know you're washing plates. I understand that. But in between washing the plates, okay, from November of 2015 till July of 2016, the market did what? All right, I'm not going to waste your time. So Nia said no new highs. Nia's close. No, Mike, but we went nowhere. Nia answered the question. Congratulations. There you go, Miss Ritchie. Good to see you, Nia. Nia's been with us for a long time. She said it. She's the smartest of you lot. She made you guys look like dodos. David was close. The market went nowhere. Exactly. So for 8 months, the market went nowhere. We just broke out this in the past month. Thank you, Nia. Think like that for a minute, and you'll see how you'll reach the promised land, all right? For 8 months, the market did nothing other than make some violent, massive swings and stuff, but it didn't go anywhere. And the same thing happens, I'll show you in the market, when every single dogmatic bear, Fed hater, you name it, political idiot who doesn't understand one thing about US economics or global economics told us that we couldn't go higher. So for 8 months, the market did nothing. So let's keep it simple. We just broke out. So give the frigging market some time to go a little bit higher. It's really as simple as that. Thank you, Nia. So saying all that, at this point, in simple terms, without getting too intricate, I've shown it very simply. I rely on technical patterns, not just my head. So one way you can look at it, and I'm removing all this stuff, is where do we think we can go? Because this is important, because every stock that you're going to trade, whether it's your Google or your Priceline, or your Tesla, well, which is a little bit nutty. It moves on its own self. But Amazon or Apple or whatever will be held hostage to what the market does. We all agree on that, right? So, we can be trading these stocks in a crappy market, not knowing what the market's going to do. So in very simple terms, the upper Bollinger right now is around 2,200. 2,200, just around the corner. Not bad. 16 points from where we closed at. We closed at 2,184 on the S&P 500 on Friday. So 16 points, multiply 16 by 7 to get to how many Dow points roughly. So we have roughly another 112 Dow points. Not much, 112. We can get it in 1 hour, right? We know that. So we got, on the upside, we got 112 Dow points here on a massive move up, which basically scares the living daylights of any of us or anyone who's short out there. We could zoom up and touch the upper end of this very large rising wedge, because we're in the middle of the rising wedge right now, right? We could reach somewhere around 2,200. Now, one of the things I would like you guys to do at your own time before you start trading this week is read this particular one that I put out there from a gentleman who's been seeing the market a lot longer than I have. Read this. E-mini possible climactic top soon. Al Brooks. Look him up. Okay? He said exactly what I'm telling you right now and what I've told you guys weeks ago. So do I take credit for that? Absolutely I will, because this is a gentleman I respect and he's kind of bearish. But he's right. So read that. Also read the Brexit news is very interesting. Like I said like I said after the Brexit, it ain't going to happen that fast. Just because they voted to get out of the EU means they can't just cut the course just like that. It's like a divorce. If you're married for 20 years and you say, that's it, honey, I can't take this anymore. I will not wash the dishes. I'm going out and I'm going to go shack up with that 19-year-old bimbo from Miami. You just can't cut the cord and walk out of the house because the assets are under both names and there's a lot of legal complications. You all understand that? So the same thing with Brexit. There's a lot of legal complications. England can just walk out. Article 50 basically says, okay, we cut the cord right now and within 2 years we're out. Now they're thinking of actually reversing Brexit. Then this particular article is also read this one. But the technical one that you should read is this one. And you'll be amazed at how what I said is pretty much mentioned in that gentleman's article. So it happens quite a bit, just so you know that. So saying all that, if we get a move up here, we're looking at 2217. At that point, if the traders who are trading with listening to what I'm doing and are staying long on certain particular stocks, they'll be getting a little bit fat-headed. At that point, the market's going to hit bang. I think this is the final week of the market going higher before we have a meaningful correction. I said that last week. Can somebody remember? Nia probably will. I put out a comment, okay, that last week was the 7th week. And this week is what week? Last week was the 7th week. This coming week is what week?
8th.
Exactly. Watch my words. Okay? This is the week the market is going to peak. And we are going to have a nice fat corrective move into the market between, I would say, we could start as early as Wednesday, to be honest with you. But 8th week, I think the market hits a high. Now, why do I say that? Because there is something in technical analysis called day count and week count. All right? And generally speaking, markets will go up 6 to 8 weeks in a row, or 6 to 8 days on a maximum move, which happened last time. Or if it goes down more than 6 days or 7 days, on 8 is the maximum amount of bars. Remember, these are all mathematical moves. If you count, okay, if you count you'll see markets in one stretch don't go up more than 5 or 6 trading days in one go. After that, it always corrects. So believe the 8th week is going to be the sort of the short-term peak in the market. So saying all that, let's look to see. Upper end of the level is 2200. That's when Apple gets to 112. Upper end of the, this is 2220. Okay, markets like round numbers. Remember that, just like stocks, they like round numbers. And so 2200 is the first move here, and after that, we'll see. Now, this consolidation band that I drew is an extremely important one. And this was also shown by some major technical analysts out there, and I did put out those articles out there showing the same. We broke out of this technical pattern here. Now, I rely on the DARVIS box, and this is something you guys need to use. If you're using Thinkorswim, just put the DARVIS box. Have that as one of your things on the screen. What does the DARVIS box do? It basically shows me that the range that a certain stock or market will travel in during whatever time period. We're obviously discussing dailies here. So on the daily, notice one thing here. The DARVIS box is extremely pinched. Look at this. You don't see that too often. In fact, you very seldom see it. Let's go back and see when the last time we saw it. 1 second. Can anyone, and this is called pattern recognition, extremely important in the business. And pattern recognition is the same way that, when you're very good at a particular thing, like a lawyer's good at looking through evidence and stuff, and boom, catches the pattern of something going on, whatever. So pattern recognition is important. When was the last time that we saw the DARVIS box this pinched? Not really. I can't see any. Can you guys see any? This pinched? No, right?
No.
Yeah, exactly. So what it's telling you is we are at this inflection point in the market here where we're just like a toothpaste. You're going to squeeze it. It's going to spurt out, and then the market's going to basically, reach where it wants to go. So in my opinion, that toothpaste spurt, if you want to visualize like that, is going to take us to 2200, roughly another 112 points. And then if it really squeezes the toothpaste really hard, then we are going to go to 2220. At that point, the market, in my opinion, is pretty significantly overvalued. Now, a couple of things here, which I've repeated before, and I say it again, is always measure. Let me hide all the drawings. Always measure the distance traveled from the moving averages. 1 second. Always measure the distance traveled from, oh boy, 1 second. Sorry about that. Always measure the distance traveled from the moving averages to where we are. What the beauty is, this is a broad-based rally. Something happened 3 days ago, which I also put an article out there, but you guys might have heard in the news too. Anyone know what the Dow Theory is? No? Okay. The Dow Theory is, anyone know? Okay, the Dow Theory is a very old-fashioned theory from, I think it's from like way back then, early 1900s and stuff, where all three major indices, or in our case, all 4 major indices, whatever, all hit new highs at the same time. The Dow Jones, the S&P 500, the Dow Jones Industrial Average, the Dow Jones Transportation Average, Dow Jones Transportation Average, Dow Jones Industrial Average, and what's the other one? Dow Jones, I forget. I know the transportation, the Dow Jones Industrial Average, and the Dow Jones, I forget the last one. And this is the first time it's happened in a long time. That means there's a lot of money going into the market. And this Brexit thing that happened, some real smart money covered their shorts, and I've talked about this a zillion times, so I don't want to repeat it again. The global macro shorts covered the 3 fat candles. That's probably a good $1 trillion right there. Right there. Good $1 trillion. Okay, that's how you got to look at things. Good $1 trillion went into the market, and then came the follow-through. And this is the follow-through that we're going through. So the real thing is not where we came from here. The real thing is where we are coming from here and where we're going. So if we draw that, which I've done for you guys several times, I'll do it again. And let's say draw it like this. We are approaching that level where it comes to the same calculation, gentlemen, okay? So it comes to the same level that I'm looking at, which is around here, around 2200, possibly a little bit higher, all right? So so there's a lot of stuff that's happening very broad-based, with money's going through a lot of sectors at the same time. It's not like the Dow Jones is going higher or the NASDAQ is going lower. There's a couple of lagging sectors. The financial sector is somewhat lagging, even though it's starting to break out. So all that stuff is going on. So enough of that. Now looking at the daily, if very simple stuff, but very important, okay? We are seeing before I go there, what's nice is, bear with me one second. What's really nice is that the moving averages are moving very nicely higher, okay, very nicely higher after crossing over here. Remember, the crossovers are critical. Once a 34 crosses over the 50 and starts to diverge like this and going higher, same thing with stocks. Start using that, employing that simple concept, okay? Whatever moving averages is used. I use 34 and the 50. That works for me great. So the 34 and the 50, they crossed over here back at the end of June, when the crescendo of, oh my God, the markets are going to fall apart. It's all horrible. The US is dying and all that garbage, okay? That is the time, was the real time to buy. We were there. Because trading is a apolitical, non-political business in my mind. You want to stay political, you'll be a trading loser for a long time to come. So saying all that, bottom line is that what's nice is these moving averages are moving very nicely higher. That's a plus. The distance when we travel too far from this is known as what? When from a certain median line you move too fast, too quick, and move away on a distance, what is this called?
Mean reversion?
No, mean reversion is when you actually fall back towards the highway. What is this called? JB, I'm asking you actually on this one. I'm calling you out on this one. What is this called? I've explained to this many times. No? No? Anyone? How about standard deviation? In simple English, simply means how much you have deviated from the mean. Mean reversion is just the opposite. Correct, I gave the correct answer, but in a different way. Mean reversion is when it reverts back to the mean. So what it did was, this consolidation channel, and listen to this carefully, it's not rocket science. You guys are very intelligent people, all of you, okay? So that instead of this crashing towards the mean and kissing the moving averages, the market stayed in a consolidation band, which I constantly kept on showing, and let the moving averages itself, listen carefully, move higher. In other words, the distance traveled from here to here, the mean was probably like a +3 or so, okay, or maybe a little bit more, the distance from the moving average to up here. Well, instead of crashing like lower, just like Fast and Furious, it stayed and what we call worked its overbought condition off. In other words, like you go to a big wedding, you go to a big feast, like feast, if you go to a real feast, you don't really have real feast in the US, right? You got to go to Asia, or you go to some distant land, okay? They have feast, man, okay? When the Chinese throw a party, that's a feast. When the Russians throw a real party, that's a feast. I don't know what we feast on here. We just basically we eat like all healthy and stuff, right? We all do. So feasting, so it's like feasting, and then what happens after that? You got major indigestion. That's called an overbought condition, okay? You feel bloated. You feel like you're, you're like some fat, what. So bottom line is, so the market feels very bloated and overbought. So instead of doing a quick, fast correction like that, it let your stomach settle by moving sideways, which is fantastic. And in between that moving sideways, we have had some tight days, and we made money on this consolidation channel big time. So many stocks that we're tactically trading. So staying in between, and this was all during the time of what? This consolidation channel was mostly during the time of what? What did we just go through and still going through right now? What season? Come on, wake up, guys. I need an answer. Anyone there? What period in the market are we going through right now? What are companies doing right now every evening? Come on, I'm giving you the answer. Anyone there? Thank you, Nia. Thank you, Nia. It's laughable that none of you are coming up with the answers, okay? Yes, we're going through earnings season. So this consolidation period was pretty much as we're going through earnings season, which is great. So in the meantime, instead of, we came close to the mean reversion, and now we're going here. Thank you for the answer. So let's go into the technicals right now. On the technical basis, the market is strong because we're staying above the 80 line here on the stochastics, which is the first derivative of the relative strength index known as the RSI, and that's a good thing. Once we start to cross below that, that means the market's starting to lose steam. Of course, I'm going to notify people when I see that. McClellan oscillator. The McClellan oscillator still has not gone positive. The bears will say that's a bad thing. We're making new highs. We're making new highs, yet the McClellan oscillator has still not gone positive. Yes, that is a valid point. The bulls will say, hey, we haven't made new highs yet, meaning like new all-time highs, so we have time for this to go positive. I will wait and see. I still think the McClellan oscillator, which has started to shrink, will go positive. Now, will it go positive like this? I doubt it. That's my opinion, because that's asking for a lot. That means we'll go to 2,300, 2,400, like bang, bang, bang. All right? I don't think that's going to happen right away. Saying all that, can we go positive by a couple of green bars? Yep. Absolutely we can. Absolutely we can. So if we're going to do that, that means we can go above 2,200 fast. Futures right now are up about 4 points. I'm looking at the screen. So getting to 2,200 is not rocket science. So so that's a positive sign. That now what will drive these candles up hard? What is a sector in the market that we have played, done very well in, but it still hasn't gone to the levels that I projected on my charts? Will somebody stand up and answer other than Nia? Okay. I'm not going to waste my time or anyone else's time. The financial sector. Biotech also. No, biotech has actually gone up. No, the answer is the financial sector. The biotech sector has actually gone up, hit certain resistance levels. The financial sector is the one that's going to cause this to really significantly move higher. So it's financial and secondarily biotechs. Biotechs have still moved up quite a bit. If you look to see what the bank stocks have done and what the biotechs have done, biotechs in general have actually done pretty damn good from the time that I showed these stocks weeks ago when everyone doubted where they could go. They pretty much hit those marks, and they have a lot more to go. So I do agree with you on that, JB. So let's move on. McClellan oscillator goes positive to a certain, let's say it goes to 100 and stuff, start shorting the market hard, period. That's just the way it goes. Now, let's take a look at a sector that I like a lot, which I think still has a lot of room to move, and that is something that I have alerted recently, and that is the, one second, that is the, what is this? Russell 2000. American, U.S. small cap growth. You heard the real chants of USA, USA in the Olympics? That's what the chant should be. Those chants shouldn't be coming of negativity. They should be coming out of positivity. That's what America stands for, okay, guys? The Olympics, the best of us, the best feelings, not hatred, not vitriol, not negativity, not garbage. That's what America stands for, all right? Believe me, I know. So the Russell 2000 US small cap growth is going to smack the bears so hard that they're going to start thinking about maybe moving to Russia. Putin, who is a complete, excuse my French, bastard, the worst guy you'll ever meet in this world, wants the demise of America. He has no good feelings for us. Believe me when I tell you. And I have great Russian friends, believe me. And I go off with them a lot, here and there. And they know how to feast, by the way. They know how to eat and drink. And they're sitting here in Brooklyn, New York. And they're big shots. Okay? Putin, in my opinion, is a complete scoundrel. So he wants the U.S. small cap growth market, the U.S. domestic economy to flounder. And we will show that it will go against him and destroy that guy. I'm telling you right now, anybody who wants to be buddies with Putin is sleeping with the snake. Remember that. Okay? So let's move on now. So the bottom line is, and I'm not talking about Russians, I'm talking about the Russian government. They're the worst of the worst of the worst of the worst. They are the reason behind so many ills of the world. And believe me when I tell you, I know more about the world than all of you guys and girls put together. All right? So U.S. small cap growth right now is, what is this particular pattern called? I've shown this pattern many times. What does it look like? What is this pattern called? Somebody step up. It's a geometric pattern. It is not a rising wedge. You're close. A rising wedge is this, Nia. Good to see you, Nia. Stop by any of these sessions. This is a rising wedge. It's like this one, but kind of like slanted up. That's a rising wedge. This is a flat top. Anything. It is an ascending triangle. Okay, ascending triangle. An ascending triangle, ladies and gentlemen, is a very powerful formation. I showed an ascending triangle on the S&P 500 about 2 months ago. And focus traders remembered that. Okay? An ascending triangle was developed here. This was the flat top. And here was the rising, this was the rising uptrend line. And the market broke out of the ascending triangle. That is what an ascending triangle is. Do not mess with ascending triangles. They make a lot of money. Okay, so instead of sitting there, where is my TF chart? Instead of sitting there and wondering what is going to happen, 1 second here. Let me get this out. This is the S&P. What is this? Hold on. We already covered this. 1 second. I thought Actually, I'll bring it up from my upper screen. 1 second. Please have patience. And we have launch. Here we go. Beauty. All right. This is a 1 hour chart. I'm already making money looking at the futures on my Russell 2000, which we have consistently played, if you remember. People who do not play the Russell 2000 are basically, the Russell 2000 is a proxy for the biotech index, because there's a significant amount of biotech, especially the smaller ones that are in the Russell 2000. And it's also a proxy for a lot of energy companies and smaller regional banks. So if you want to play the whole thing in a lump sum, please feel free to trade the Russell 2000. I have consistently shown the Russell 2000 as a big money maker. Russell 2000, JB remembers, they were up more than 1,000% in 1 week. This is the 1 hour chart, ascending triangle. Once we break over the 1232, I'll give it a little bit of room. This is, remember, this is the TF, right? So that's the futures. So let's call it 12, we closed at 1230 roughly, 1229.82 on the Russell 2000. If it breaks over the 1232 mark, let's take a look on the daily, what can happen. Because what has happened over the Russell 2000, let's actually look at the weekly, is we haven't even come close to touching the highs. In my opinion, and this is heavy duty marching soldiers, what we call upwardly moving candles. The Russell 2000, the high was about 1293. I'm sorry, let me actually pull in the rut so you guys can remember. That's better. The high on the Russell 2000 was 1286, 1295. All right. If you guys should remember, let me do the week daily, that I drew this pattern, and this pattern is called what? This W pattern is called what? Tim, if you're dragon bullish, there you go. Tim, JB, are you learning from Nia? I'm serious.
Yes, I'm watching.
Okay, watch. Anytime you see a big W pattern, this is a dragon bullish pattern. I drew this pattern off this level, calling this a major double bottom. The monies you can make, and we made, from this 1100 level up to 1200, a $10,000 investment here, I repeat again, is possibly 160,000 here. So while you sit around, while many traders, not you guys, but many traders sit around, complain, moan and groan, not focus, and do all kinds of idiotic stuff, and then keep on telling their little pea brain in their head, well, there's always a next time, which is the dumbest thing a trader can ever tell themselves. Honestly speaking, I've been there, I know it. Everything I teach, I've been there. Okay, so no one can tell me I haven't been guilty of that. Well, stop doing it. Now, I'm not saying that you put the $10,000 here or $5,000 here or $1,000 here and just close your eyes and say, okay, no, I know it's going to go higher. But once a pattern is developing and manifesting itself, don't sit around like a bozo, please. Don't make Putin happy. I know I'm ragging on Putin. I can't stand that guy. And neither can my Russian friends, by the way, in a funny way. So the bottom line is that don't make the enemies of the U.S. happy by our downfall. Nothing makes them happier. You think just terrorism itself destroys America? Whether it's, Islamic jihadist terrorism or other bozos and school shootings and some white nationalist idiot trying to shoot other people. No, what kills us is economic terrorism. They want to destroy us out there. By economically, when we are weak, we are the strongest country in the world. And when we lose that strength economically, nobody would need to put bombs in our place. We'll just done. Because nobody gives a hoot about people who are poor. So if U.S. turns into a poor, economically weak nation, then nobody's going to even listen to us. And we never want to go there. Right? We never want to go there. Trust me, I've traveled the world more than enough than all of you probably have put together. So economically, we have to stay strong. And for that to happen, our markets need to stay strong. Remember that. All right? So never, Okay, let's move on. So at this point, we have a massive dragon bullish formation. I drew this chart way back in June when I saw this happening. People who followed this trade did extremely well. Remember, we have a significant amount of members who don't come in the chat room. They're busy. Who talk to me on the side, send me a text and stuff. You won't imagine what some of them are, the monies they're making. It's not even funny. And they thank me and they give referrals and it's great. I'm happy for them. They have taken these sessions, by the way. They've been around for a bit. So they help. So this pattern that's developing right now, first of all, there's a very broad channel, okay? And the upper end of the channel is 1300, which seems very far away. But if you notice every single time that we do hit the upper end of the channel, yes, it might take an extra month or so. This is really for swing traders. Okay, so in your portfolio, maybe a small portion of your portfolio should be purely for swing. And every time it kind of, the pattern, as long as the pattern stays the same, you keep on adding on pullbacks. And that's where you make the real big money. Volatility is crazy, I know. And I know it's some days it's really scary, like is the pattern completely changing, is things intact and this and that. That's only normal. I've been there, I know it. So saying all that, it either touches the upper end of the channel or gets close to it. Well, that was a downtrend line. Once it broke out of the downtrend line, something else happened. A bull flag was formed, and I'll show that to you right now. And when a bull flag is formed, respect it. The Russell 2000 has not even come close to making new highs. Correct? You'll know that. So the bottom line is, by the time that indices makes a new high, I think that's the point where the market is like, whoa, overbought, big time. And I've seen this happen in years before. That's the reason why I'm saying it. So if it does get closer to the upper end of the channel, we're talking 1300. Ladies and gentlemen, we closed at 1230. If this is a 70-point move, you will make, I don't know, 2,000%? Rough calculation in my head. A $4 call will go to like 100. And it sounds crazy, but that's the way it works with these things, right? 2,000%. And come on, it's not a joke. So this is the pattern that is manifesting itself. I think I said about biotechs when they were down that what they would do, they did exactly that. So looking at this thing here, let me take out this dragon bullish formation and move this. Let me actually draw more over it so you guys can see that. Now remember, I wasn't there buying the Russell 2000 at 900 because I was focusing on the S&P 500. But once it crossed over the 34 moving average over 1,000, I was back in the game on that. I was back in the game in that. I'm going to focus on the Russell 2000 more going forward, as well as the S&P SPX. So please focus when you see that. They're great money makers. There was times on when I back in the days when I didn't have my service, I used to exclusively trade Russell 2000s. They're volatile. Sure, they're volatile. But, you know, if you want to make good money, then all these things are volatile, period. There's no way around it. So you have to scale in. Trade management number one. You have to scale in instead of jump in at one go. So here is this channel that this is now going. Let me change the color. And keep in mind, these are all my opinions. I could be wrong. I have the right to be wrong. But I'm just sharing with you what I think is playing out. And like they say in life, nobody cares about people what they think unless they show a track record that they've been right many times before, right? Exactly. So if I've been right a heck of a lot of times before, so obviously I carry some credibility. So that's what I'm showing you, ladies and gentlemen. All right. So anyway, so this is your bull flag. And once it breaks out over the bull flag, it is going to have an open gap to run towards this 1290, 1300 level. Focus on the RUT calls. You can buy them in the money. 10 points out of the money are the best ways to play it. So if the 1230, then you should buy the 1235, maybe 1240s. And on a power move type of up, you can always manage your profits along the way. But it looks pretty damn good for a possible breakout, which is this, like this. All right, so that's it. Now, saying all that, let's take a quick look at where we are. I will cover one or two stocks that you guys are looking at or very interested in, and then we'll wrap up. So this is where we are right now. Real time after hours. So far on the 1 hour charts, we are not overbought. This is nice. We need to go overbought like this before it goes. And I draw a lot of lines. Obviously, that's what I do for a living. Okay, I'm a chartist. So this is the main channel that we're following. Extend to the right. Oh, it is extended to the right. Extend to the right. Bingo. This is the wide channel that we're following. This is your consolidation channel. Actually, I'll take this line out. Yeah, this was sort of the wide band. We broke out of it, and then we created a small consolidation channel, which was this. 1 second. What is a consolidation channel? Where the market trades in a very tight band, goes back and forth, profit taking, all that stuff. So this is the band we are traveling in right now. I try to show this every morning, as you know. And once we break out over 2185, well, or not, more like 2190 in the case of the S&P 500, this is the channel we're going to enter. That shoots up to about 2200. So we could get 2200 on the market as early as Tuesday afternoon. If we get a big sell-off tomorrow for whatever reason, that means the market has flushed out the excesses, just as they did last week and the week before. Every Monday sell-off was the best time to buy and sell towards the latter part of the week. Yes or no? You guys all saw that, right? Every Monday, if you get a big sell-off Monday, you get all the tactical resets and all the stuff that I show. That's a good thing. Monday sell-offs are good in upwardly trending market. Monday sell-offs are not good, remember this, in downwardly trending market or bear markets. That means things are going to just fall apart. But Monday sell-offs are good because it washes away the froth to set up nice prices for the latter part of the week overall. So saying all this, once we enter the on the E-minis over 2188 or so, and we're almost there, 2183 over, then this channel comes into play. Upper end of this channel, as I explained, is in that 2200 range. So that's where really we're going. And you know, we're long SPX calls, we're long RUT calls. Individual stocks that have been showing will accordingly follow the market, and then we'll take one step at a time. Now, Nia, what stock would you like to see? Let me show you one stock which I've been long, still long, taking some profits, but damn good, is Yelp. When you see a major technical breakout on a stock, okay, a major technical breakout, let me hide all these drawings. You have to respect it. Look, I don't care about Yelp. I started using Yelp a bit, you know, just sort of not writing reviews and stuff, but using it. It's a pretty good, you know, thing. What do I care? All I know is the stock was considered to be, you know, a lot of fraud and this and that, and that people were writing fake reviews. I really don't care. What I'm looking at is the weekly, and that to me, ladies and gentlemen, is powerful. Look at that massive cup formation with a double bottom. There's a double bottom. Well, actually one bottom, but I would draw it like this. Okay, so the upper end, the most the stock can get to is somewhere between 50 and change. Okay, another 12 points. That's a lot of money because Yelp things are cheap, right? They go from $1 to $3. You know, it's like Priceline where you have to get a second mortgage to buy a Priceline call, right? So overall, I've shown in my other tactical charts that there's a minor gap here, very minor. So that's 44 level. But this candle is powerful. So it has to, yes, I'll see Netflix in a second. So this is a powerful candle. That's a breakout. One candle doesn't just snuff itself. Yes, anything can happen. I understand that. Somebody goes, oh, well, yeah, well, no. This is the way it works. You get one candle like this. Yes, you might get a little pullback, maybe $1 or $2, but another candle will form, and the candle will eventually slow down on the third candle. Now, when these candles are forming, remember one thing, when these candles are forming, they don't form on top of each other. The next day, they'll probably pull back a little bit and form from here. Does everyone understand that? It's very simple. That's just the way that they kind of overlap each other. That's why I say things don't just go up in a straight line. Yes, this might pull back $1, people freak out and stuff, but as long as this trend line stays as long as this pattern stays intact, you're looking at mid-40s to $50. That's a lot of money. Okay, play it right. That's a lot of money. In the meantime, we've been trading the stock from earnings, so that's great because this earnings. Somebody asked me what changed in Yale. I said earnings, because that's exactly what changed. Their earnings showed that this company can play in a different league. There's your breakout. There's your breakout. I've drawn this chart in many different ways on my Twitter feed, so please go take a look at it. I am doing it in a there's your band. It broke out of the band. See you later. Okay. And the third line that you can draw, there's many different ways you can draw this. This is my way of doing it. I would say from here, watch this. Extend to the right, make the line thick, make it blue. There you go. And it hits, bingo, 44. Now, why did I draw this line? If somebody wants to learn about technical analysis, very simple. I looked at this low. Okay. I look for another touch point. You normally should have about 2 or 3 touch points. And I extended that line. And it hit 44. That's it. It's not rocket science. All right. So that's it. Now let's take a look at Netflix. Netflix, I have the chart put here. And it's a great chart. It really is. This is a chart that you can tell our esteemed, even our great politicians who are trying to run the country, right? You can show this chart to them and they'll understand it. That's a big thing. This is a 5th grader chart. So let me just look at it this way. Nia, you broke out of this line. We'd like to stick with the breakout. We want candle development further. $100 at the upper Bollinger. Of course, we're going to hit some resistance at the green line here, which is around 98. What we don't want to see is this turnaround. What we don't want to see is this turnaround go below the 50 and the 34. Now remember, this is a daily. That's what we don't want to see. Below the 50 and the 34, come back and then try to find some home at 90. Now, at that point, if you see it, I'll obviously be monitoring it very closely. I would say that the Netflix closed at around 96.51. So somewhere around 93, believe it or not, is basically, it seems a lot, but somewhere anywhere below 93 is when things change. And then 90 becomes the buy point again. Okay? So that's the way it works. What we would like to see, to be honest with you, this week is these 2 dots get filled, $100. Of course, at 100, they'll be selling. It's $100, blah, blah, blah. But it means nothing because the 100 means that we're going to do the gap fill. And that gap fill, ladies and gentlemen, is 102. And the upper gap fill is 106. Now, I've read it, things, and something in me tells me, who knows? Netflix might be cutting a deal with one of these big e-commerce companies in Chinese e-commerce companies and stuff because that's what they do. Can you imagine? The stock will be up $6 in 2 minutes. So, but before you make that, you take advantage of that type of move, you have to be positioned in the stock. Okay. Any other quick stock that I can look at? Tim. Anything quick? Tim, you there? Let's take a look at Tesla. And I will go on the daily because it's a stock that no one really quite understands, but I'm going to show you something which could happen. Highly volatile. but something's brewing out there, okay? The technicals are not fully matching. The daily is telling me it wants to reset it a little bit lower, which is fine because it's getting close to the lower end of the scale. But here's a pattern that's developing that I showed a while ago, okay? And that is this very large head and inverse head and shoulder. Head, left shoulder, which the 200 level or so, okay? Left shoulder, and the neckline, which is up here in the 272 level. That's 50 points higher. So that's one big macro picture, right? Here's the other macro picture. Inverse head and shoulder again. Head, left shoulder at around the 212, 215 level. You notice how it bounces off there. A neckline at 240 and the breakout of the neckline saying, see you later. Now remember, this stock is heavily shorted. A break below the 215, 212 level will cause the stock to kind of fall. Not saying it's going to go to 200, but this is the danger zone. But if it continues with this type of pattern and constantly keeps on holding, and this shoulder keeps on holding around the 215 level, then the chances of a breakout are pretty good. And even if it doesn't break out, and even if this goes to 240, that's 15 points on some pretty cheap calls to play on it. On that note, I shall run. Thank you for attending. This session will be uploaded for free tonight on the YouTube channel, Clueless Trading. I've shown some basic concepts, but important ones. I have put some of my thoughts on the economy and what's going on. Be cautious. Always be looking over your shoulder. All right? But at the same time, look forward. Study my charts. Use your own brain. Use your own charts. Follow other services who are giving some very very useful resources or pointers on what's going on. Put them all together and make money. God bless you all. God bless the USA. Thank you for listening.